welcome to CNBC TV18. I'm Ekta Batra and with me is Pavitra Parekh from the Delhi studios, and you're watching Your Stocks. Well, it's turning out to be a session where we're seeing a lot of traction coming into the financials today. So the Bank Nifty is currently outperforming, up around 0.8%. We have the mid caps, which are seeing a little bit of pressure but have recovered definitely from the day's low. So no real panic selling as we saw in yesterday's trading session. The Nifty just about consolidating with a positive bias, up around 80 odd points. Hi, Pavitra.
Hi, Ekta. I mean, we've definitely seen quite a good recovery play out. Like you mentioned, for the mid-cap index, it's over 400 points in terms of a recovery. And the good news is that the banks have also come off significantly from the lows, led by a lot of the private banks. So, definitely not shaping up to be too bad. But on that note, let me welcome our guests on this show now. We have Rajat joining us. He's going to take us through all of the technicals. And then we also have Sharad Avasthi joining us from SMIFS, and he's going to help us with the fundamental side of things. So, Rajat, Sharad, as always, thank you very much for taking out the time and helping us with all of these individual queries that have come in. The first one is a query which comes in from Sambi Reddy, who writes in from Andhra Pradesh. He holds 100 shares of HDFC Bank at 1,630 rupees, so making a little bit of money over there. He also has 150 shares of UPL, which he bought at 666 rupees. So these two investments making a loss on UPL, but HDFC he is managing to make some money. Says that he's a long-term investor, but he has a very specific question, which is that what could the target price look like in the next 18 months? Sharad, you want to come in? I know two completely different stocks, but take us through what you would expect on these from, a 1 to 2 year kind of perspective.
See, I'm bullish on both stocks, though HDFC Bank has been an underperformer of sorts over the last 2-3 years, where there's not been much of an improvement. But now with the merger completed and the bank going in for aggressive growth targets over the next 3 to 5 years, I think there is a possibility that every quarter the numbers will receive a very good response from the markets. And generally the scene around banks should be very strong over the next 3 to 4 years because most of the NPA pressures are not there anymore. For HDFC Bank anyways, it was mostly irrelevant. I think for HDFC Bank, the big trigger will be that the post-merger entity will grow at a much higher rate vis-a-vis the earlier 3 to 4 years in the way they have grown. And I think that should result in a lot of re-rating for the bank. And I think the fair value for the stock should be around 2050-2100, trading at 3.5 times price to book forward. So I think that's a bank that you should continue to hold in spite of the underperformance that it has seen over the last 2-3 years. I'm very bullish on the stock over the next 1.5-2 years to at least, and beyond that also. UPL, again, I think it is also an underperformer, and actually it has corrected substantially from the highs due to the numbers that they have reported and the inventory issues. But we think that most of the problems are behind us, and going forward, the innovative product pipeline that they have, that should help. And every quarter the numbers should be much better on a YOY and QOQ basis going ahead. We are expecting though muted top line growth of 7 to 8%. But on the bottom line side, I think they could easily report an EPS of somewhere around 80 in FY26. And based on that, I think 1200 rupee target is something that I'm betting on. So I think anything between 900 to 1200 is the target on UPL. But I'm very confident. I think you should continue to hold on, extend your horizon to say 24 to 36 months. I think 1200 is a very good possibility on the stock.
Coming in. Okay. All right. Let's get in another question then. We have Irvin T, who writes to us from Bengaluru. He holds 50 shares of Strides Pharma, which is bought at around 385 rupees, and 7 shares of Bajaj Finance, which he's bought at around 6,500. He wants to know the future prospects of both of these investments, Bajaj Finance as well as Strides Pharma, sitting on a profit for both of them. But Rajat, do you think that it's good for more?
Yeah, I would say that there is no reason to get out of Strides Pharma as of now, because it has crossed its 200-week moving average after third attempt and now consolidating around those levels. The 200-week moving average is currently at around, say, 445, and as I see that currently it is trading at 466. Chances are that this stock is going to move further up. So one can continue to hold on with a stop below, say, 414 or so. That's your Strides firm. I always come up with an old name, Strides Arpalab. Anyway, the other stock was Bajaj Finance, right? I would say that Bajaj Finance, if you are a long-term investor, definitely continue to hold on, because Bajaj Finance, over a period of time, has established its competitive advantage, and the kind of ability that it has, that is, I have seen with my own eyes that yes, they take only 2 minutes to give a loan. Within that, they manage to assess your creditworthiness and all that. So Bajaj Finance is not a pushover. It's going to be there, and any newcomer, however big that is, Bajaj Finance can sustain itself. So I would suggest the investor to continue. Put a stop loss below, say, 6,800 or so.
Okay, all right. That's on both of those queries. Just want to point out that we have been pointing out that it's really a lot about the financials this afternoon. So as you can see on your screen, we have the Bank Nifty, which has been outperforming up around 0.9%. But the other segment is the Nifty PSU Bank, which is now creeped all the way to a record high. So it's just made its way to a record high, up around 3.6% for that particular index. This is at a time where we have the mid caps, which are showing sluggishness. Stocks such as PNB, UCO, Canara Bank, Bank of Maharashtra, Bank of Baroda, all up and about in today's trading session. The big boy State Bank of India also up around 1.4%. PNB, for example, is seeing a good amount of volume traction, up around 6.8% for that particular counter, which has given returns of around 27% on a year-to-date basis. But Sharad, getting back to the queries, we have Strides Pharma as well as Bajaj Finance. Do you see that there's further upside fundamentally on both of these counters?
Strides, I feel there is a strong possibility that it could get re-rated very strongly over the next 2-3 years. They are very strongly focusing on the CDMO business, and the company is guiding for around $400 million sales out of that only. So I think that's around 3,250 crores additional. If the company can pull this off, I think there is substantial scope of getting re-rated. Valuations per se are not very expensive. FY25, we are expecting the company to report an EPS of somewhere around 40 rupees. So I think even if it conservatively trades at, say, 15-20 kind of multiples, you could be looking at targets of somewhere around 700 on the stock. Bajaj Finance, while what Rajat has said is totally true, that they have created a niche for themselves and they are still targeting aggressive growth rates. But the way the balance sheet has grown from 40,000 crores to around 2,70,000 crores, I feel at this scale to grow it at that pace would be a bit challenging for them, and they're already trading at a future 2-3 year forward price to book of somewhere around 4.5 times. So I think there the possibility of you making much more returns from these levels is very difficult, and I feel that the Bajaj Finance book sustaining a price to book multiple of 7 to 8 times would be very difficult going ahead. So I think that is a stock which I would tend to book profits and exit at these levels.
Okay, got that. In fact, our next query is also one which is on the financials. So we have Naresh Gogia, who writes in from Mumbai. He holds 150 shares of Poonawalla Fincorp, which he bought at 350. Now, he says he's a short-term investor and he wants to know what he should do. Should he book profits or stay invested? The stock is currently close to around 375, so he has made good money on this one. Rajat, he has only, a 3-month kind of view on Poonawalla Fincorp. Would you suggest he book his profits, or do you think if you stay in for another 3 months, you can make more in this?
See, a small bounce back can happen. It's not that it is definitely going to happen, but it can happen where it may move to something like 385 to 400, anywhere between that. But that should be used to actually exit this stock, because the 9-day as well as the 50-day moving averages are both coming down, and 9 days piercing from above. This is a death cross, and when a death cross happens, initially you are lured into buying it with all kinds of candles, like a spinning top, inverse spinning top kind of thing, doji formation. So bears are undecided. They are not undecided. They are just waiting for the higher prices to sell again. It would be a good buy only when it comes close to its 200-day exponential moving average around 340, not before that, because there is 90% chance that it will actually test that 340 kind of level. So if I were him, I would have waited for the levels to come, and then I would have considered buying or not buying. Not at current prices anyway.
Right, that's on Poonawalla Fincorp. But Archana now writes to us from Madhya Pradesh with an investment query. She asks if she can invest in stocks such as Apollo Hospitals, Aarti Pharma, or Time Technoplast. Well, Sharad, would you have a query? Would you have an answer on this? Because they're very diverse sectors that she's talking about: hospitals, pharmaceuticals, and even Time Technoplast. What would you recommend?
I think if you want to go safe, Apollo Hospitals makes a decent bet at these levels. The valuations are on the expensive side, but forward growth is expected to be very strong for the hospital over the next 2-3 years. And on a bed capacity of around 10,200 beds over the next 3-4 years, they are planning 2,000 additional beds. And they're also talking about the revenue per bed or occupancy basically to be increased to 70%. That should do very well for the hospital chain. So I think considering 40-50 times, which is the lower band of the valuation that the stock gets, and with growth rates of 35-40% over the next 2-3 years, I think it should not be very difficult for the hospital company Apollo Hospital to sustain at around 45-50 kind of multiples. So that is one stock. If you want to play safe, you could bet on it with a possibility of a target of somewhere around 6,000, 7,000 on the stock. The other two stocks, I think Aarti Pharma is a very good story, but you have to take some risks there. It's already trading at 20 times, but the capex that they are doing with respect to the xanthine capacity, I think that should augur very well for them. The first phase of capex is 300-350 crores. The second phase is further addition to the capacity. I think there is a possibility that this company's earnings could double over the next 2 to 3 years. So it continues to command a multiple of somewhere around 15-20 times. Then there is a possibility it could double, but there is a risk of execution in terms of the capex and everything that they are doing, and it's a substantial capex vis-a-vis the existing operation. So that is the risk you are taking on. And regarding Time Technoplast, I think the products they have developed are very attractive if they get some permissions from the auto component manufacturers regarding the use of composite cylinders, etc. That could snowball them into a different league. But 13, we expect the earning to be somewhere around 13 rupees for the company. And I think with the kind of traction that we have, there is a possibility that Time Technoplast could have a target of somewhere around 225. So if you want to play safe, go for Apollo Hospitals. If you have to take some risk, I think amongst Time Technoplast and Apollo looks better in terms of the capex commitment that's already there. If you are looking at a multi-bagger story that could really translate into something else over the next 3 to 5 years, where the products have new age usage and all that, whether into hydrogen cylinders and everything, then Time Technoplast also makes a good bet. If you want to choose one, I think Apollo makes more sense with the risk-return adjusted perspective.
All right, that is very helpful, Sharad. And actually, we have a whole host of more queries that have come in as well. But we have to take a short break right now. Rajat, Sharad, please stay on because we have lots more and we're going to get to that in just a bit. Welcome back. You're still tuned into your stocks here on CNBC TV18. By the way, for the market, like we were pointing out, the Nifty is doing very well, 90 points higher right now. And even the mid-caps have recovered so well because now we're almost in the green for the mid-cap index as well. So around 500 points from the lows of the session. It's, been quite a smart recovery that we've seen. But we have a lot of more queries coming in and we still have Rajat and Sharad with us to take you through all of these queries. In fact, our next guest is on the line with us. Balu is calling in from Bengaluru, and he has made some investments in Take Solutions as well as Coal India. Mr. Balu, if you can hear me, please go ahead and take us through your query. Both of our guests are on the line as well, and then they can help you out.
Yeah, thank you. Good afternoon all. So I have a query regarding Take Solution. Like I bought 1,200 at the price of 660 rupees, and now it's going around like 20 around. And one more query regarding the Coal India. I bought like 580 quantity at the price of 260. So Coal India now doing good. So I just want to know, like, should I wait for? I initially planned for the short term, but I plan to hold for some more time or to get out of the loss.
Okay. All right, let's get in both of our guests on this. Sharad, coming to you first, and let's talk about Take Solutions first because he is seeing quite a loss coming in over there. He has been holding for a while, bought it around 60. Stock is at closer to 20 right now. Do you think it makes sense to hold the faith and just expect slightly higher prices here, or would you advise getting out of this one?
See, the debt resolution problem that they have resulted in one of the major subsidiaries getting sold off. They have received some 38 crores from that sale, but 70-80% was the business from coming there. The business as it is has seen some slowdown, the pharma R&D business basically in product launch phase 1, phase 2, phase 3. So I think that is where Take has taken a hit. I think Take, you can hold on as a high risk investment and zero hero trade basically. Either it will turn into something big with the numbers happening over the next 3-4 quarters, but I think existing numbers don't really give you any promise that something humongous is going to happen at Take. And the only positive side is that they have a lot of relationship with big pharma companies due to their past engagements. Because of that, if they are able to scale up their existing business, that should be good. Leverage now is not very humongous, but it's still there. So I think Take has a few challenges to address in the times to come. But I think the standalone business can grow at a rapid rate. So that is one thing. But you have to understand it's a high risk trade. You have to go in with the mentality that more or less you have lost a major part of your capital. But I think you can continue to hold on to it as a high risk trade. If things do mature positively based on the relationship the company has, then it could go up substantially from here. But as of now, I can't see anything on the company.
All right, a little bit of a tough situation on Take Solutions. Sharad, what would you advise on Coal India? This stock has been doing very well. In fact, a bunch of the PSUs have been doing very well. But on Coal India particularly, do you think this is one you should stay in?
Yeah, I think optimistically, if you expect 35-36 rupees kind of earnings, we expect to be stable for the next 2-3 years. Optimistically, it could get somewhere around 8-9 times. So 325 kind of targets could be there. And the second phase of capex that they are doing into alternate energy, renewable energy and hydrogen as well. Beyond that, beyond the next 2-3 years, that should hold in good stead. But if you don't have a very long-term horizon and if you're not happy with the 5-6% kind of dividend yield it will transpire into, I think you should gradually start exiting around these levels to 325. At current levels, you could exit 50% of it and then gradually keep exiting till 325. I don't see humongous gains happening over the next 2-3 years. I think the big gains will happen once the alternate energy type kicks in the numbers of the company.
Okay, all right, Sharad, as well as Rajat, we're going to let you go on that note. Always a pleasure to hear your views. Thanks very much for joining in and taking us through those queries. Well, we leave the markets in fine fettle because we have the mid-cap index, which is recovered, and it's probably just going to break into the green as well. Let's see if that takes place in the last hour of trade. The Bank Nifty also at the high point of the day or close to those levels, up around 0.8%. PSU banks at record highs. It's a wrap on the show. Closing bell up next.